What is up, guys? Welcome back to my channel. My name is David Hamlin, aka the Laptop Legend, and in today's video, I'm gonna be sharing a sad but true tale with you of how I pretty much got myself banned from Fidelity. Now, I wish this were an April Fool's joke. I really do. I was planning on doing some type of April Fool's joke on you guys, like saying I sold all my MIDI or something like that, but it turns out I get to make this video instead. This is going to explain why I was using Schwab today and why I didn't trade yesterday, and it's going to get you guys all on the same page. And basically, I just made a really idiotic mistake that a lot of you guys are probably making. I just trade a lot more than most of you guys, so if you trade at the level that I trade and you make this idiotic mistake, you are putting yourself in the position to get your own account banned. And trust me when I say this, you do not want to get your account banned because it is a pain, and I realize how much I like Fidelity after trying to trade on Schwab. So there's a lot of reasons for that, and I guess I'm just gonna dive into them. So it's probably easier for me to explain if I dive into my computer. But you know, I guess just to give a little background information, essentially the reason why I got banned from Fidelity was because I forgot to click the like button on this video. So make sure you do that if you don't want to get banned. Gotta click the like button, subscribe if you haven't already, and turn on post notifications because I post videos, well, I guess not every day now. I missed one day this year, but pretty much every day. All right. Let's dive into my computer and I'll explain exactly why I got banned from Fidelity and how you guys can avoid it. All right, guys, so the error that I committed that you guys may have committed yourself at some point is called a wash trade. Now, if you've been watching me for a while, you probably remember my video called, on the topic of the wash sale. These are two completely different topics. A wash sale is when your losses are pushed forward because you rebuy the same stock in terms of your cost basis for basically accounting purposes and for taxes purposes. This is not, I repeat, it is not a wash sale. A wash trade is completely different, and this is what I was doing on accident. So let me read the definition for you. Wash trading is a process whereby a trader buys and sells a security for the express purpose of feeding misleading information to the market. In some situations, wash trades are executed by a trader and a broker who are colluding with each other, and other times wash trades are executed by investors acting as both the buyer and seller of the security. Wash trading is illegal under U.S. law, and the IRS bars taxpayers from deducting losses that result from wash trades from their taxable income. Now, just so you can understand a little bit of the history of this, wash trading was first barred by the federal government after the passage of the Commodity Exchange Act in 1936. It was, popular back in the 1930s as a way of stock manipulators to falsely signal interest in a stock in an attempt to pump up the value so that these manipulators could make money shorting the stock. And from what I've heard, it kind of sounds like what a wash trade is and what these laws are designed to prevent is, sketchy CEOs and market makers who have a ton of volume, a ton of shares from a really cheap price that they want to dump. They basically buy shares from themselves to artificially pump up the volume, get it on people's scanners, and basically create demand. People see there's volume, they think there's buying demand, so they come buy the stock, and then the people short it, and it comes back down. That is kind of what wash trading is. And the reason that I accidentally did this was due to a couple of reasons. And again, I think you guys may have encountered this scenario. So for me, I'm not artificially, where is it? I'm not feeding misleading information to the market. But what happened was, accidentally, I served as both the buyer and the seller of a security. Now, if you trade OTC stocks like I do, you've probably encountered this issue where you have an order that you place, and then you suddenly realize you don't want to place that order, and you try to cancel it. But instead of instantly canceling and verifying cancel, it gets stuck in a state called pending cancel. And this happens because you're not trading directly on the exchanges. OTCs, over the counter, it's through the broker-dealer network, so it's not as quick. So occasionally you'll get stuck in a pending cancel, either on a buy or a sell order, and they can end up filling you on your buy or your sell 30 seconds, a minute after you tried to cancel it. Now, I'm going to describe a couple scenarios where I personally encountered this issue so you can keep them in your mind and be extremely careful to avoid these scenarios. So the first one that I want to talk about is where I have a pending cancel of a stock that's going up. So I have this little mini whiteboard here. I'm playing the teacher today, and I just want to draw this so you guys can see a little bit, right? So there's a stock, you know, it's going up a little bit, and it comes back down, and then it keeps going up. And say I try to buy, you know, right here, right where this line is, and this is 10. This is 10 schmeckles. That's where I want to buy, right? I want to buy a stock at 10 schmeckles. The stock is going up, and maybe it's currently trading at 9.5 schmeckles right here, right? So I put a buy limit, 20,000 shares at 10 schmeckles. But because it's the OTC, even though there's still sellers at 9.5, I don't get filled. And it keeps going up. Suddenly it's printing 10 schmeckles on the time and sales. And then suddenly it breaks through, and now it's over. And now it's printing, damn, now it's all the way up at 12 schmeckles. I don't want to buy it at 12 schmeckles, so I cancel this order. I'm like, nah, I don't want to buy this. I don't want to buy this anymore. It's up a lot. If it comes crashing back down, man, I think this thing is going back to 4 schmeckles. And I don't want to hold this into 4 schmeckles. So I try to cancel my order, right? But it gets stuck in pending cancel. And the stock starts coming back down. You know, a big seller comes in. Maybe he has 1 trillion shares of the stock. He's selling 1 trillion stocks. And it starts pushing the price down. Suddenly it's back under 12. Suddenly it's coming back down, and it just goes straight into a free fall. Now it's at 10 schmeckles again. It's back at 10 schmeckles, and my order is still live on the market because it's pending cancel. Hasn't verified cancel yet. All right. I have a 20,000 share buy order for 10 schmeckles, and suddenly I get filled half my shares. So I just got filled 10,000 of my 20,000 order. That's a partial fill on a pending cancel. This happens to me all the time on stocks like AABB. I mean, I feel like that's where it happens the most, but I mean, it happens on a lot of other stocks too. And maybe ENZC, that's another one that happens on. So you can see, you know, I'm partially filled, but I think this thing is going to keep, you know, I think it's going to keep going down a lot lower, you know? So I want to get out as soon as I can. So I take those 10,000 shares that I was just sold that I didn't want, and I sell them market before my pending cancel has officially canceled. And by doing that, well, I end up selling directly to myself. So I sell 10,000 shares, and I end up filling myself because I still have 10,000 shares buying at 10 pending cancel. So I end up filling myself those shares, and I sell to myself. That is technically a wash trade. I am serving as both the buyer and the seller of the security. And that is a violation. That is a violation of SEC codes. Now, am I doing this because I want to pump up the stock to scam other investors and, you know, provide misleading information in the market? No, obviously not. I just want to get out because I got stuck in a pending cancel. But it doesn't matter. It doesn't matter. And you got to make sure that you do not put yourself in this position. Because if you do, and you do it too often, you're going to get your account suspended. You're going to get your account suspended. And this could happen on any brokerage, not just on Fidelity. Not just on Fidelity. So you got to keep that in mind, guys, because I don't want to see anyone else suffering from this type of issue. Now, if you trade very rarely, or, you know, you make 10 trades a day and this happens, you know, once a month or something, it's probably not going to be a big deal. But if you make like 1,000, I don't even know if I make 1,000, maybe 500 trades a day like I do, and there's a day where you have it happen like 4 or 5 times in a day because you're trading the same stock over and over, and there's a lot of pending cancels, that starts to look pretty suspicious, and your broker has to, you know, crack down on you. So that is just one way that I have suffered from this. Now, there's actually other scenarios, and I just want to talk about them because I want you guys to avoid running into them. So the main other scenario where I encounter this issue is, let's see. Let's say a stock is trading at, let's say it's trading at 19 cents, right? It's trading at 19. Let's say there's a bid at 19.1. Let's say 19.1. There's a bid at 19 as well. Sorry, I can't really draw here. So there's a bid at 19.1 and a bid at 19. And then the ask is at 19.5. Okay? 19.5. Golly, I got some really bad handwriting here, guys. It's really tough to write with a mouse. But you kind of get the basic idea, right? So there's a wall of buyers here. There's a wall of buyers at 19.1 and a wall of sellers at 19.5. If I think the stock could probably keep going, I'm going to be buying up in this area. So I might buy on the ask. I might try to see if I can get filled halfway between. Or I might put my buy, right at 19.11. So I might try to buy, right here. I might try to buy right there and get filled, right? So let's say I just bought there, right? Let's say I just bought there. Let's say I just bought at 19.11. Okay, cool. So now I got 10,000 shares from 19.11. Just keep that in mind. Now, I'm looking at the level 2 on the stock, and I'm seeing, okay, we got some nice bid support here at 19. But wait, under that, the next thing that I see is all the way down here at 15. 15 schmeckles is the next bid support. And I'm like, wait a second, that's an air pocket. There's an air pocket in the stock. And this happens a lot in OTC land because a lot of these stocks are so thinly traded. There's not anyone who's willing to buy it under 19 until it gets down to 15. And I'm thinking to myself, wait a second. If it drops all the way down there, it's probably going to see a nice little bounce because people are going to see that huge red candle and they're going to dip by it. So I'm thinking, all right, let me put another buy order right here at 15.01. Right? And I mean, this could be 0.1501 if you're trading, penny stocks. It could be 15.01 cents. But you get the idea. I put a buy order for 10,000 shares right at 15.01. So now I have a buy order here. And I just bought right here at 19.11, I guess. Yeah, 19.11. So I just bought here. And now I'm thinking, all right, it's going to go higher. So it tries to go higher. But then a big wall of sellers steps in. A big wall of sellers. I mean, I'm talking a big wall of sellers. Selling 1 trillion stocks. So it starts crashing back down. Suddenly it breaks through the wall at 19.0. And suddenly it's printing red on the time and sales right at 19. And I'm thinking, oh my gosh. This thing's about to drop. I thought it could go higher, but now it looks like it's about to drop. I'm going to try to cut these shares because I think best case scenario, if it falls all the way down here, what? It's going to bounce up to, 17? It's going to bounce up to 17? So if I get filled at 15.01 and I still have shares from 19.11, best case scenario, I'm getting out at like a tiny loss, pretty much break even. And I don't want that. So let me try to cut these shares here and then I'll get back in. So I have my, my order set up there and I sold market, right? So I sell market when it's printing 19. When it's printing 19, there's a bunch of red prints. I'm trying to get out at 19 before it cracks. So I sell market, but I'm unable to get out. And suddenly, I'm the next best bid. So now I'm selling market to myself at 15.01, which means my 10,000 shares execute here. Bada boom, bada bing, takes out my buy order. So I just sold to myself at 15.01. Now the next best one is at 15. Now they're selling a couple at 15. And then it instantly bounces all the way back up to 17.5. But because I sold to myself, I don't get filled any extra shares down here. So I might as well not have gotten filled at all because I sold to myself. So it's pretty much like I still have these shares from 1911. So not only do I miss the dip buy, but I also sell to myself, which again is a wash trade, which is against, it's against the rules. So these are just a couple scenarios where you got to be really, really careful. And I think the biggest thing is when you're mixing market sells and limit buys at certain prices, you just got to be really careful. If you have a buy order in, you got to be really careful with market sells, guys. And sometimes it could cost you a little bit more money. If I have 10,000 shares, I don't want to take a washout from 19 cents all the way down to 15, I guess, cents, schmeckles, whatever. That's a 400 schmeckel loss. It's a $400 loss right there. I mean, that's a lot. I don't want to lose that, so I would rather get out quickly, and it's easier to get out quickly if you use a market order. But sometimes you just got to realize it's not worth it. it's not worth it because I've already lost a lot from opportunity cost of not being able to trade because I got that issue with my account. So it just stinks, guys. It really stinks. And what stinks even more is that they said they gave me a warning because I wouldn't have kept doing this. I mean, I didn't realize it was such a big deal, but it's a really big deal. They said they gave me a warning email, and I never got one. And I'm not just saying that. Like, I checked my spam, I checked my trash, I checked my inbox, everything. Nothing. Didn't receive anything. So I wrote a letter to them, and we'll see what happens. We'll see what happens. I'm hoping they reapprove me, and I can be, you know, a lot more cautious in the future. But I just want to make this video so you guys know what the potential is if you mess this up, because Fidelity is, if you do the type of trading that I do with OTCs, Fidelity is really the only good option. It's really the only good option because TD Ameritrade, you're paying the fee. E-Trade, you're paying the fee. I just switched to Schwab. I got a Schwab account, and they don't let you use any type of margin on OTCs. So even if you're over the PDT rule, it's as if you were under the PDT rule. You basically trade with a cash account for OTCs, which does you no good at all. So on Fidelity, if I have a $30,000 account, I'll trade $400,000 worth of OTCs per day. But on Schwab, I can only trade $15,000 per day because I got to average out those, you know, it takes 2 days to settle. So if I have a $30,000 account, I use 15, then I use 15. And then the next day, the 15 from the first day has settled and I can use it again. So it's just really frustrating. It's really frustrating looking for solutions to a problem that shouldn't exist in the first place. So that is what's going on with me. And I want to read what their definition was. So they said if there's no... All right, so what I said was, I said to the Fidelity representative, I said, I trade a lot of fast-moving stocks, and sometimes I need to cut positions quickly. Is there a specific length of time I need to wait between a buy and a sell order so I can avoid future issues? And they said if there's no gain or loss on the position between the buy and sell, and they are around the same time, that's a major red flag. There's no specific length of time per se. Wash trades are seen as an instrument to artificially inflate the volume of the security, which is where the market manipulation piece comes in. So again, based on that definition, guys, it seems like the only way this would happen is if you end up selling to yourself, because it would be right around the exact same time, or I mean literally at the exact same time, and there would be no change in price. There would be no P&L on the position. So, you know, I think if you buy a stock at $2 and then you cut it at $2 10 seconds later, I think that's fine. I think that's fine. But if you're buying from yourself on accident because of this, it is a very, very bad thing, and I did not realize that before. So hopefully this video will help you guys to avoid that issue and avoid getting banned, because it's a pain in the aerobed. I had to censor myself there. Don't want to lose monetization. All right, guys, that's it for this video. Hopefully you found it helpful. Remember, we got no trading tomorrow. If you're watching this video when it comes out, if you're watching this video 10 years later, there might be trading tomorrow. So I guess don't take my word for it. Check the calendar. And I'll see you guys in the next video. Until then, you know the drill. Let's grow better together. Preguntar, bebé, dime por qué te mientes. No puedes esconder todo lo que tú por mí sientes.